What's going on, everyone? Broke Investor back. I'm here to talk about dividend stocks. And actually, today's video will be about something that I had to, research about myself today and yesterday because I was about to make a decision without doing the research. So I decided to, do some comparisons, pull up some data, which I did, and again, I decided against it. So, long story short, I own a dividend stock called PETS. 1-800-PET-MEDS is the company name. Actually, no, the company name is PetMed Express. You know them as 1-800-PET-MEDS if you use them. So they're, they sell pet medications, and they've been battling as of late, struggling against the competition. So they missed revenue on their earnings call the other day, so I was kind of pissed off about it. And they also didn't raise their dividend last year, which I just realized, and I was kind of angry about that. So those two things alone made me just, push against the stock, which, I shouldn't have. So, for no reason at least. Without, digging further and going back to why I originally invested in the company. Rather than jump to conclusions just because I wanted to buy something else, I shouldn't go off and sell something, just because, out of aggravation short term. So long story short, I wanted to sell it and I wanted to buy Caterpillar. I still want to buy Caterpillar, but I wanted to sell Pets to buy Caterpillar. And that's what I'll go over today, and I'll basically analyze, I'll compare the two, although they're in different sectors. I'll just, compare certain statistics that would, otherwise make me, make the decision. Again, they're not related, but you could still do a comparison of, certain stats that would make you feel comfortable buying in one versus the other. Because as a dividend investor, the idea is you buy a stock and you hold it forever and you collect that dividend. You don't want to go and keep selling off, companies that you own, because again, the original idea of you investing in that company was to hold them for the lifetime. You want to believe in that company. You want, just because of a bad quarter or two, you don't want to go running away already and selling off those shares. So, this video is more of a reality check for myself, and I just wanted to, kind of talk about it with everyone else on YouTube, whoever watches my channel. So let's get to it. So, oddly enough, when I made this, I was realizing how this looks: pets versus cat. Obviously, cat is a pet. So this is not on purpose. Believe me, Caterpillar is a company I've been watching forever. And I'm going to invest in them. It's just a matter of when. And Pets is a company that I've been owning for a while, and it's a company that I actually do use. So anyway, so as I said, Pets stands ticker symbol PETS is PetMed Express, and Caterpillar is ticker symbol CAT. And what do they have in common? Why am I comparing these two? Basically, well, not only because, again, wrong place, wrong time, and right place, right time, but they have the same pay schedule. So I try to focus and balance out my months. Again, the quarter end months, the March, June, September, December. Those are the heavy months. So I don't want to forget about the 25811s. So both of these pay 25811. So if I was going to sell Pets, I need to replace that income in February, or in May and August, November. So it's easy. It was easy for me to make that choice because Caterpillar was already on my watch list and they've been down as of late. So that's the main reason I'm doing a comparison of these two. As I mentioned before, they have different sectors. Pets is in the consumer defensive sector. The industry is pharmaceutical retailers, and Caterpillar is in the industrial sector, and the industry is farm and heavy construction machinery. The big differentiator here is the size of the companies. Pets is a hell of a lot smaller than Caterpillar. I'd rather invest in larger companies because, again, they're stronger. They can make it through the difficult times. Pets has a market cap of 467 million, making it a small cap stock. And Caterpillar has a market cap of 80 billion, making it a large cap stock. The current stock price, although irrelevant for the most part, Pets is $25.62, when I checked this morning, and Caterpillar is $145.85. They both pay quarterly, as I mentioned, on the 25811 months, and their quarterly dividend for Pets is 27 cents, and their starting yield is 4.22%. Caterpillar, their quarterly dividend is $1.03. And their starting yield is 2.82%. So obviously right off the bat, as you can see, Pets is more attractive from a starting yield perspective, but you cannot judge by that. Believe me, you cannot ever judge by that. Although it's very tempting to get into a stock that's automatically going to pay you a high income, but do not worry about that, please. Next topic is back to, in follow-up to the dividends, let's just compare over the past 5 years what the dividend payout was. So over the past 5 years, Pets has paid the following dividends: 71 cents, 75 cents, 79 cents, $1.04, $1.08, showing a 5-year growth rate of 52.11%, which, it's an average of 10% a year. That's not bad. Greater than 10% a year. Caterpillar, their 5 years was 294, 308, 310, 328, 378. 5-year growth rate 28.57%. Not as impressive. That's about a little above 5% a year. So, once I saw this, I'm like, okay, Pets, I thought they had slow dividend growth, but it's looking pretty good next to Caterpillar. So then I thought, okay, let's look at the revenue, and I compared the last 4 years of total revenue, and I'll start with Pets again, from 2016 to 2019. Now this is 234 million, 249 million, 273 million, and 2019 was 283 million. Every year it's gone up, but the 4-year growth rate was 20.77%. That's not too bad, right? That's about what, 5%? 5% increase a year, decent. Caterpillar, again, over the same 4 years, 47 billion, 38 billion went down, 45 billion, and then 54 billion. So it did go down, but it then recovered, showing a 4-year growth rate of 16.4%. So, obviously, Pets does look good again, even in the revenue. 2019 was a tough year for them. They had a lot of competition. Chewy went public, and Amazon, Walmart. There's a lot of players in this field. But the one thing they do have going for them is there's a lot more. There's a lot of business. A lot of the market is huge, and they only have a small portion of that right now, so there's a potential for growth. So one other thing I don't have on the board is the equity. So I compared the equity, which is assets minus liability. PetMed Express, I just compared from 2016 to 2019. PetMed Express had 83 million in 2016, and in 2019 it had 134 million in equity. That's the 61% increase. So their balance sheet looks pretty damn good. Caterpillar, not so much. 2016 they had 14 billion in equity, and 14.8 billion. In 2019 they had 14.0 billion. So that's a 5% decrease in equity for Caterpillar. So again, PetMed or Pets has dominated so far in my comparison. So as you can see, there's one other factor, 5-year capital gain, which Caterpillar did hold the win. PetMed Express, the capital on the stock price went up 69%, and Caterpillar went up 72%. Only a 3% difference. So as you can see, Pets is looking pretty strong next to Caterpillar, such a large company. So there was one other thing I thought about, which is competition. As I was saying with Pets, they're facing a lot of competition. They're facing competition with Chewy, as I mentioned, especially since it went public, and Amazon and Walmart just got into the space. So they had to kind of cut their prices as of late, so their margins are a lot less, which, they're struggling right now, but I think, they're going to work on their advertising, as they mentioned, over the past, and their website, e-commerce and everything. So they're going to work on that in the coming quarters and years. So hopefully that should catapult them and get them back to, solid growth. They've had growth every year, so hopefully they can keep it up and start increasing their dividend. Caterpillar's competition is John Deere. Everyone knows John Deere for the most part, and I read China is getting involved, so they're coming into the U.S., bringing on some competition. So we'll see how that goes, though, with this whole tariff thing and whatnot. But so that's basically the summary. And long story short, the decision has been made that I will hold Pets. And I am holding Pets because I was very impressed, again, looking at their history. And it's not like I haven't looked at their history before. I kind of needed to remind myself that they are growing. They are doing well. And I can't jump to conclusions just because of one bad quarter. Or if I'm reading a negative report, or I'm reading the stupid comments on Seeking Alpha. You cannot be that way. You have to trust your original, your gut, your big fat gut that told you to buy this stock. And why did you buy this stock? Because you believed in the company. So no, I'm not selling Pets. My dumbass is not selling Pets. And I'm not buying Caterpillar, obviously, at the moment because I don't have the funds. I was going to have the funds once I sold Pets, but I'm not. Caterpillar, although numbers not so great, yes, it's hard to keep growing the revenue when you make that much money as it is, and it's just a steady company. So I still do trust Caterpillar, but again, this is more so not about Caterpillar but about Pets, and me kind of reminding myself what I'm doing, just kind of check myself. Again, I'm a dividend investor, so the idea is I buy stocks and I hold them and I collect the dividends. I don't automatically reinvest those dividends. They go into the account as cash, and then I deposit new money. So I add those funds together, and then I keep buying more and more and more stocks. So Pets will remain in the account. I will continue to collect their dividends. Will I reinvest more money? Maybe. I mean, the stock's been going down. It went down like 6% yesterday. Today is Wednesday. It's going down about 5% last time I checked. So if it keeps going down, sure. After this review, I will buy it. So long story short, this is just a reminder to everyone. You don't need to jump to conclusions. Just as you should track your stocks quarterly here and there. Annually would be smarter because it's the overall picture. But definitely do not jump to conclusions when you see a bad quarter, or a bad comment, or a bad article, whatever. Just keep the focus and stay with it. Again, this is your money, so you need to, go with what you feel, with the numbers that you trust. Everyone does their own analyzing, their own formulas, etc. So do what you have to. Again, I'm just a broke investor. I'm not a financial advisor. I'm just here sharing my journey, as I go. I'm learning every day. I'm brand new. I'm not brand new. I'm in 2 to 3 years now in the stock market, but I'm trying to share videos, podcasts, etc. as I go. So hopefully the newbies can learn from another newbie rather than learn from someone who's already successful, making millions already. Again, this is a get-rich-slow strategy. This is more realistic. This is very simple and safe, in my opinion. So, again, I'm the Broke Investor. If you enjoyed this video, please click like, please comment, and please share. And obviously subscribe. I'm looking to get more subscribers as I stay more consistent with my videos. I've been slacking, obviously. I also have a podcast, also called The Broke Investor, and I have an Instagram under The Broke Investor as well. So, anyway, thanks for watching, and I'll talk to you later.